Hey everyone, welcome back for another deep dive. You ready to get into it today?
Yeah, let's do it.
So today we're going to be looking at the Indian stock market.
Right.
And for this one, we're using a newsletter from Volatility Coaches of India as our source.
Well, that's good.
So when I think about the Indian stock market, I think of potential growth, but I also think about volatility.
Yeah.
What are some of your initial thoughts when you hear those words, Indian stock market?
I think of a lot of opportunity, but as you said, a lot of volatility. It's been kind of a roller coaster ride for a while now.
Yeah. And actually, this newsletter doesn't shy away from that volatility at all. One of the first things I noticed was they talk about all these parameters they call RVCC parameters.
Interesting.
And they list a bunch of them.
Yeah, I noticed those too. And I think it's a really good way to kind of get a snapshot of where the market is.
Yeah, like a health check.
Exactly. They list things like PE ratio, PB ratio, MG, RSI, FII, Nifty, and even the VIX, which all of those can tell us a lot about what's going on in the market. So the PE ratio and PB ratio, those are pretty standard, but some of the others are a bit more unique. Like MG stands for margin of safety.
Oh, interesting.
Which basically tells you how much room you have before you start losing money on an investment.
Okay, so like a buffer.
Exactly. And then RSI, or Relative Strength Index, is more of a momentum indicator.
Okay.
It helps you see whether a stock is overbought or oversold, so you can get a sense of potential turning points.
So like if a stock is overbought, does that mean like it's probably about to go down in price or?
Yeah, it could be a sign that it's due for a correction, but of course you always want to look at multiple indicators and not just rely on one.
Right, of course. So MG and RSI, I think those are pretty clear now.
Mm-hmm.
But what about some of the other ones they list? Like what is FII? I've never heard of that before.
So FII stands for Foreign Institutional Investors,
Mm-hmm.
and they're really important because they're some of the biggest players in the market.
Oh, okay.
When FIIs are investing heavily in India, it can really drive up the market. So paying attention to their activity can give you some insights into the overall sentiment.
Okay, that makes sense. And then Nifty, I think I've heard of that one before. Isn't that like an index of some kind?
You got it. The Nifty 50 is one of the most widely followed indices in India. It tracks the performance of the top 50 companies on the National Stock Exchange.
So if the Nifty is going up, does that basically mean the Indian stock market in general is doing well?
Yeah, pretty much.
Hmm.
It's a good benchmark for the overall health of the market.
Okay, so we've got these RVCC parameters that are giving us like a snapshot of the market's health. And then the newsletter also mentioned something about projected returns for the Indian market.
Yes, based on their analysis, they're projecting an annual return of around 6.2%.
6.2%.
Okay.
And what are they basing that on? Like, is that just a random number or?
No, it's definitely not random. They're taking into account things like economic growth, dividend yield, and even something called reversion to the mean.
Reversion to the mean, what is that?
So basically, it's the idea that markets tend to balance out over time. If the market is currently overvalued, it's likely to drop back down towards its historical average, and vice versa. If it's undervalued, it will eventually go back up. So they're factoring in this tendency for the market to correct itself.
Okay, that's pretty interesting.
Yeah.
So 6.2% projected return based on all these factors. Does that number seem good to you? Like, how does that compare to other markets around the world?
Well, it's always important to look at things in a global context, but in general, 6.2% is pretty much in line with long-term historical returns for the Indian market.
Yeah.
It's not necessarily a spectacular return, but it's decent and relatively stable compared to some other emerging markets.
Right, so it's like slow and steady wins the race kind of
Yeah,
thing.
exactly. It's about long-term growth and not trying to get rich quick.
Okay, so we've got our RVCC parameters. We've got a projected return of 6.2% for the Indian market. Where do we go from here? What else does the newsletter tell us?
Well, this is where things get really interesting. The newsletter starts to give some specific advice on what to do in the current market environment.
Like what kind of advice?
Well, for example, they say that if the Nifty falls below 23,000, investors should consider converting debt to equity.
Okay, hold on a second. Let's unpack that a bit. So first of all, what does it mean if the Nifty falls below 23,000? Like, why is that number significant?
Right. So remember how we said the Nifty is like a speedometer for the Indian market? If it falls below 23,000, it's basically saying that the overall market is experiencing a pretty significant dip.
Okay, got it. So if that happens, they're saying to convert debt to equity. What does that even mean? Like, how do you do that?
Well, essentially it means shifting from owing money to owning assets.
Okay.
Debt is like borrowing money. You have to pay it back with interest. Equity is like owning a piece of a company. You benefit if the company does well.
So if the market is down and you think it's going to go back up, they're saying it might be a good time to buy into companies at a lower price.
Exactly. And if the market recovers, those pieces of the pie you bought at a discount could become much more valuable.
Okay, I see. So you're basically trying to take advantage of the dip in the market.
Yeah, that's the idea. It's about being opportunistic and adjusting your strategy based on the market conditions.
Okay, so converting debt to equity. But how do you actually do that in practice? Like, what are some concrete steps people can take?
Well, that's where things can get a little bit more complicated. And the newsletter actually goes into some detail about different options, like refinancing loans or even using assets like gold or fixed deposits to invest in equity.
Wow, so they're really encouraging people to seize the opportunity if the market takes a dip.
Yeah, they definitely seem to think it's a good time to be buying.
But they're not just suggesting buying any stock, right?
No, they
Yeah.
get pretty specific. They also talk about transitioning from flexi-cap to multi-cap funds at lower levels, which is getting into the nitty-gritty of mutual fund investing.
Okay, so it's like we're starting to get into the weeds a little bit here.
Yeah, we're about to dive deep into the mutual fund jungle.
All right, well, before we do that, let's just take a step back and recap what we've learned so far.
Sounds good.
So we've got these RVCC parameters that help us understand the market's mood. We've got a projected return of 6.2% based on a bunch of factors, and we've got some pretty bold advice about converting debt to equity and shifting investment strategies if the market takes a tumble. Anything else I'm missing?
I think you covered the main points. So far, so good.
Okay, great. So this is just the tip of the iceberg though, right?
Oh, yeah. There is a lot more to unpack. The newsletter goes on to analyze market trends and specific sectors in even more detail.
Okay, so we've still got a lot to cover.
Definitely. There are some really fascinating insights waiting for us.
All right, well then let's dive right in.
Yeah.
What else have these volatility coaches got for us? Okay, so we've got a good overview of the current state of the Indian market, but now I'm curious about the actual journey. Like, how has the market been behaving over the past year or so?
Yeah, that's a great question. And the newsletter actually takes us on a bit of a ride starting from January 2022. They pinpoint these shifts in market sentiment, going from negative to positive and back again. It's pretty interesting.
Oh, wow. So it's not just a steady climb upwards.
Not at all. There are definitely some twists and turns along the way. For example, they point to a negative trend around March 2022. Then there's a brief surge of optimism around March 17th, and then back to a more cautious or negative outlook in April.
It sounds like a dance with steps forward and steps back.
Exactly. And to understand this dance, they use a tool called the 13-day exponential moving average, or 13 EMA for short.
13 EMA, okay. And what is that exactly?
You can think of it like a trend line that smooths out the daily ups and downs of the market. It gives you a clearer picture of the overall direction.
So if the market is dancing above the 13 EMA, things are looking good. And if it dips below, it's time to maybe reconsider those dance moves.
That's the basic idea. It's not a foolproof system, of course, but it's one of many tools that traders use to gauge momentum and potential shifts in the market.
Okay, that makes sense. So the newsletter highlights specific dates where this crossover happened, suggesting changes in the overall mood of investors.
Right. It's like getting a behind-the-scenes look at the market's choreography.
I like that analogy. But for someone who's not a professional dancer, what does paying attention to these signals actually mean? Like, how does it help me make decisions?
It's all about context. These technical indicators, like the 13 EMA, are just one piece of the puzzle. You also need to consider broader economic trends, company-specific news, and most importantly, your own investment goals and risk tolerance.
Right, so you're saying don't just follow the signals blindly, but use them to inform your own research and decision-making process.
Exactly. It's about being an informed investor, not a passive one.
Okay, that makes a lot of sense. And speaking of research, the newsletter also zeroes in on a few specific sectors: banking, finance, IT, and pharma.
Yeah, those are definitely some key players in the Indian economic landscape.
So why the focus on those areas? Are they the stars of the show?
They're definitely some of the leading actors in the Indian economic drama. These sectors play a crucial role in the overall growth story, and their performance can have a significant impact on the market as a whole.
Okay, I see. So banking and finance, those are pretty obvious, right? They're closely tied to economic activity. But what about IT and pharma? What makes them stand out?
Well, IT is known for its innovation and global reach, and pharma is a major player in the global healthcare industry.
Okay. So they're suggesting these sectors are worth paying close attention to.
Right, but they don't go into too much detail about specific opportunities or risks within each sector.
So it's like they're giving us a treasure map, pointing us towards promising islands. But it's up to us to explore those islands and find the buried treasure.
Exactly. That's where our own research comes in.
Okay, I like that analogy. So we've got our map, we've identified the key sectors, but now we need to dig deeper. And I have a feeling that's where the sectorial index data comes in.
You got it. This is where we start to get into the nitty-gritty of how different types of companies are performing and how they're being valued by investors.
Okay, so we're looking at a spreadsheet here with a whole bunch of numbers and ratios. A little overwhelming, to be honest.
Don't worry, I'll be your guide through this numerical jungle. What they're showing us here are key differences in the performance and valuations of large cap, mid cap, and small cap indices.
Okay, so large cap, mid cap, small cap. Can you just remind me what those terms mean again?
Sure. Think of it like a spectrum of companies based on their size and market value.
Okay.
Large cap companies are the giants, well-established, and often with global operations.
Got it.
Mid-cap companies are somewhere in the middle with good growth potential.
Okay.
And then small-cap companies are the up-and-comers, often with more volatility, but also the possibility for explosive growth.
So the spreadsheet is basically telling us how these different types of companies are doing and how investors are valuing them.
Right. And one of the first things I notice is the difference in PE ratios across the categories.
PE ratios.
Okay.
And remind me again what those are.
The PE ratio tells us how much investors are willing to pay for every rupee of a company's earnings. Higher PE ratios generally indicate higher growth expectations.
So a high PE ratio means investors are really optimistic about the future of that company or sector.
It could, but it's important to consider all the data points together. For example, we see that mid-cap indices like Nifty Midcap 50 and Nifty Midcap 100 have significantly higher PE ratios compared to large-cap indices like Nifty 50.
Interesting. So investors are more bullish on the growth potential of mid-cap companies.
That seems to be the case, but their dividend yields tend to be lower.
Dividend yields? What are those again?
That's the percentage of a company's share price that it pays out as dividends to shareholders.
Right.
So lower dividend yields in mid-cap companies could indicate that those companies are choosing to reinvest more of their profits back into growth rather than paying them out as dividends.
Ah, okay. So it's a bit of a trade-off, higher growth potential, but potentially less immediate income.
Exactly. And that's why it's so important to understand your own investment goals and risk tolerance. Are you looking for steady income from dividends, or are you willing to bet on higher growth potential with more risk?
Right. It's like choosing between a reliable workhorse and a promising but untamed stallion.
I like that analogy. Both have their advantages and disadvantages.
Okay, so we've looked at the PE ratios and the dividend yields.
Yeah.
Anything else jumping out at you from this data?
Well, it's also interesting to look at the price-to-book ratio, or PB ratio.
Yeah.
This compares a company's market value to its book value, which is essentially the value of its assets minus its liabilities.
Okay.
A low PB ratio could suggest that a company is undervalued by the market, while a high PB ratio could indicate overvaluation.
So it's another way to gauge whether a company's stock price is in line with its actual worth.
Exactly. And this data can help you identify potential investment opportunities or areas to avoid.
Okay, so we've covered a lot of ground here with this sectorial index data, but there's one more piece of the puzzle we haven't talked about yet, the India VIX.
Ah, yes. The market's fear gauge.
What's the latest reading on that?
As of February 9th, 2025, the India VIX was at 13.69, which compared to the previous week's value of 15.96 suggests that investors are feeling a bit more optimistic.
So the fear is subsiding a bit.
It seems that way. But of course, market sentiment can change quickly, so we'll have to keep an eye on it.
All right. Well, then let's see what final wisdom the volatility coaches have to impart. What are their parting thoughts on the Indian market? Okay, so we've decoded the market signals, we've dug into specific sectors, and we've even braved the world of index data.
It's been quite a journey.
It has. But for the grand finale, what's the overall takeaway? What are these volatility coaches ultimately saying about the Indian market?
Well, they end on a pretty optimistic note, highlighting the potential of the Nifty Small Cap 100 and Nifty Mid Cap 150.
So even though the overall market projection is 6.2%, they think these smaller and mid-sized companies might outperform.
That seems to be their bet. They point out that small and mid-cap companies often have higher growth potential.
Right. But we also talked about how they can be a bit riskier. So
Really?
why aren't we all just ditching our large cap stocks and going all in on small and mid caps?
Well, diversification is key. You don't want to put all your eggs in one basket. Smaller companies can be more volatile and susceptible to market swings.
So it's a balancing act, like choosing between a seasoned veteran and a rookie with potential.
Exactly. The veteran might be more reliable, but the rookie could surprise everyone.
So this newsletter isn't just about giving stock tips. It's about understanding the bigger picture and the different options available.
Absolutely. It's about empowering investors to make informed decisions.
So as we wrap up this deep dive, what are the key takeaways?
First, remember those RVCC parameters. They're like a compass for navigating the market.
Second, the market is a dance, not a straight climb. There will be ups and downs.
And third, do your own research. This newsletter is a great starting point, but dig deeper into the sectors that interest you.
Because this isn't just about numbers and ratios. It's about your personal financial journey.
Exactly. And with the right knowledge and planning, you can navigate the Indian stock market and achieve your goals.
So to our listeners, what asset allocation would you feel most comfortable with in the Indian market right now? And why?
There's no one right answer. It depends on your individual circumstances.
That's right. So thanks for joining us on another deep dive. And remember, invest wisely